If nobody can afford the house, why isn't the market crushing? Ever since prices skyrocketed in 2020, everybody is waiting for a 2008 style collapse. But here we are, and the market hasn't crashed yet. If you're looking to buy a house and you're waiting for a housing crash, this might be the most important video that you will ever watch. When people say that buying a house back in the days was much cheaper, it's true. Back in 1960s and 70s, the median household income was about $5,000 to $6,000, while the median house price was $12,000 to $15,000. Homes were only 2 to 3 times the average income, a ratio that made it realistically possible for most people to save for a house. You did not need to take a mortgage. If you saved for a few years, you could have paid for it outright. And if you did not want to wait for a few years, you could have taken a mortgage. 50% down payments were extremely common. With half of the house already paid off, mortgage payments did not hurt even if mortgage rates were extremely high. Even in early 1990s, buying a house was still affordable. The median household income was $30,000, while the median house price was about $120,000. Yes, the gap was widening, but home ownership was still within a reach for most families. But everything changed because of this man, Luis Raineri. You're looking at the face of a man who made housing unaffordable in America unintentionally. Before him, housing was boring. Banks would lend money and would hold into these mortgages for the next 30 years. So banks had to be very careful about who qualifies. If the borrower defaults, the banks takes the losses. With that kind of responsibility, they naturally played it very safe. Demand for housing was very limited. People either rented, or even if they bought a house, they saved for a few years, and even if they took a mortgage, they would make a 50% down payment. That was a minimal risk for the bank, and it also made monthly payments very minimal. It allowed people to prepare their mortgages much sooner. Housing was a place to live, not a financial instrument. While working for the Solomon Brothers and trading securities, he introduced the idea of turning mortgages into securities and lobbied Washington to legalize them. At first, it did not attract a lot of attention. It was new, complicated, and nobody knew how to monetize them. However, Wall Street quickly realized how much money could be earned from these mortgage-backed securities, even though that it was detrimental to the average American in the long run. An entire industry was formed by bundling mortgages into securities and selling them to investors. Because these securities were backed by a real house, it was easy to market them, so investors loved them. It was also a great news for the banks. Banks no longer had to hold into these 30-year mortgages. They would create the mortgages and sell them to investors at a profit and quickly cash out to create more mortgages. So that's when the incentives flipped. Investors wanted more mortgage-backed securities, but to create them, you had to create more mortgages. So lenders had to make it much easier for people to qualify for these mortgages. So they relaxed the credit checks, they allowed low or no down payment at all, they pushed adjustable rates, they also approved borrowers who previously would have been denied. More people qualified, that meant more demand, and that meant higher housing prices. At the same time, mortgage rates fell down. Because mortgage-backed securities attracted investors from all across the globe, mortgage rates in the US fell down. Borrowing money became cheaper, credit became more affordable, and while that boosted affordability in the short run, it created unsustainable surge in demand. That huge demand pushed house prices to a completely new level. Since 1990s, house prices have increased by 250%. Inflation has increased by about 130%, while wages have increased by about 80 to 100%. So essentially, house prices grew 3 times faster than the average income. House prices grew so fast that the consumer price index that tracks inflation had to exclude housing because houses stopped behaving like a consumer product. They became an investment tool. But before I tell you the real problem, there is something important that I want to share with you. Microsoft recently announced that they made an additional major investment into OpenAI, in which Microsoft will hold 27% stake in the company, worth approximately $135 billion. The stock instantly spiked right after the announcement. It was news to the public, but I was able, using today's sponsor Moomoo, to track a significant amount of bullish insider trading activity a month before the announcement. And that's just the tip of the iceberg with Moomoo, because it's one of the most powerful trading and investing platforms, a platform designed by traders for traders with features that truly stand out. It's backed by Futu Holdings, a company that is listed on the Nasdaq and trusted by over 27 million users across the United States, Canada, Australia, Singapore, Malaysia, and Japan. Moomoo offers many features, including a personalized AI assistant and an institutional tracker. There is $0 commission fee on stocks, options, and ETFs, $0 contract fee for equity options, free level 2 data, real-time option chains, and advanced order types for traders who want full control. If you are ready to join me and 28 million others using Moomoo, then scan the QR code on the screen or click the link below this video. For a limited time, as a thank you note, you can get up to $1,000 worth of NVIDIA stocks if you sign up and make a deposit using the link below this video. Because mortgage-backed securities were relatively a new financial instrument, investors were afraid that the mortgages inside them would default, so they purchased credit default swaps, essentially an insurance against those defaults. Investors and the banks were confident that they're protected against any kind of defaults, but insurance companies on the other side have sold far more credit default swaps than they can possibly cover. Imagine an insurance company insuring your car but don't have the money to insure it. Then you get into an accident and the insurance company cannot possibly cover it. The insurance company goes broke. Now scale that to millions of mortgages and you have a recipe for a disaster. So from 2003 to 2007, house prices increased by 35%. This was the fastest increase in house prices until everything collapsed by 2008. By 2007, the total value of the credit default swaps increased to over $60 trillion. When investors realized that, they started massively selling off their mortgage-backed securities. That led to a banking crisis, and a banking crisis led to a housing crisis. Between 2020 and 2022, house prices increased by about 40%. So why is the housing market not collapsing, especially when this spike was much bigger and much faster? So after the 2008 financial crisis, the government introduced multiple regulations to prevent insurance companies from selling more insurance than they can possibly cover. And that limited the ability of the banks to provide mortgages. So they only provided or offered mortgages to responsible borrowers whose income they can possibly verify. That dramatically reduced the number of high-risk mortgages. Since then, the total value of the credit default swaps have fallen from over $60 trillion to as low as $5.5 trillion. Do you see the difference? So a 2008-style financial crisis today is almost impossible, but 2020 still should have caused a massive housing crisis. When you're making your mortgage payments, the investors is receiving your mortgage payments. And when suddenly there is a global pandemic and unemployment suddenly rises, people stop receiving their paychecks, they stop making money, which means that they stop making the mortgage payments. Suddenly investors stop receiving these mortgage payments, which means that they will start massively selling off these mortgage-backed securities, which is going to trigger a banking crisis, which is going to trigger a housing crisis. Especially international investors, when they realized that the United States closed its borders, they massively got rid of their mortgage-backed securities. But the Federal Reserve stepped in and it started buying massively all these mortgage-backed securities. On one side, the Fed prevented 2008-style financial crisis. On the other side, the Fed made housing so dramatically more expensive. And as they say, never let a good crisis go into waste. Since Wall Street had access to cheap money, they borrowed money, bought houses, outbidding every single regular family, turning these houses into mortgage-backed securities and then selling them back to the Federal Reserve. Taking that profit, taking that cash, buying more houses and outbidding every other regular average American family, turning these houses into mortgage-backed securities and selling them back to the Federal Reserve, since the Fed was literally buying every other mortgage-backed security in the market. This never-ending loop is the reason why house prices increased by 40% during the pandemic. Unlike 2008, we don't have an insurance crisis today, and for the housing market to collapse, then the Federal Reserve needs to massively sell off these mortgage-backed securities. But of course, it's not going to do that. The job of the Fed is to protect the economy and not crush it, which is why the 2008-style financial crisis is almost impossible today. But if home prices are so expensive that nobody can afford them, why do house prices keep rising today? Until 2022, interest rates in the European Union, the United Kingdom, and even Japan were literally zero. So investing in government bonds in these countries made no sense whatsoever. You're literally making 0% on your investment. So pension funds and large institutional investors invested a big chunk of that money into the mortgage-backed securities in the United States, driving mortgage rates to the bare minimum all across America. But now, interest rates in the EU are much higher, in the UK as well. And even in Japan, that had deflation for a very long time, where Japan lowered interest rates below 0%, they have increased their interest rates. So, hundreds of billions of dollars that previously flew into the United States mortgage-backed security is now back invested in those countries, which is another major reason why mortgage rates are not coming down all across the country. But investors are still buying mortgage-backed securities. However, not randomly. They're very selective. When you get a mortgage, the bank collects very important information about you. Your income level, your default score, your credit score, your prepayment speed, and even your zip code. All of this information goes into the mortgage-backed securities, giving investors very important insights about which neighborhood to invest. If a mortgage-backed security pool shows that borrowers in Phoenix with a zip code of 12345 never default, investors pay attention. Wall Street looks a very potential good opportunity. So they start massively buying mortgage-backed securities in that zip code that lowers down the mortgage rates in that particular zip code, which increases the demand, which is going to lead to higher house prices. Every mortgage-backed security also includes house value updates. So if a mortgage-backed security shows that house prices in that specific zip code have increased and rents are also growing while construction is very limited, Wall Street pays attention that this is a very great, safe, good opportunity. So they start buying mortgage-backed securities out of that zip code, which is going to lead to higher house prices in that particular zip code. So mortgage rates are essentially falling down to responsible buyers, and house prices at the same time are increasing, while house prices are falling down in very bad neighborhood where buying a house is basically a very bad investment. And that's exactly why the housing market is not crushing, and may not for a very long time. And that's why instead of just waiting on the sideline and waiting for a crash, the smartest move right now would be to start investing and take advantage out of the market. And if you don't know where to start, here is a fully animated video that will literally teach you everything you need to know about investing.